So you guys are going to have to watch the videos. Okay. You knew you were going up against some time competition. Well, you know, they are only about 28. They can just grind through. Keep it fresh. They just grind down the pack. They just don't care. This is a shame. So I would pull out your your portfolio worksheet, and I'll walk you through the construction of the fund of funds. Okay, so here's the worksheet. Here's the worksheet. So we all know how to draw out the efficient frontier, the global portfolio, capital allocation line, utility curves, the bowing out of the efficient frontier, the 40% global equities, 30% global, 40% global bonds, 30% global equities, 10% global alternative renewable energy, 10% global, what's the next one? Alternative renewable energy, global, direct commercial real estate, and 10% FX currency portfolio. So that's your target, your model portfolio. And then give me the allocations and give me it again. What I did was, this is just kind of a worksheet. I would be writing this stuff on a separate piece of paper, and then when you're got it all fixed, then you can carry it over, and this will be your master sheet. I use whiteout too, sometimes just to clean stuff up. So when I'm handing this in, I'm not giving somebody, something that's been scribbled. So I usually will either have a worksheet or I'll use, white paper. I know it's a little redundant. You can use an Excel spreadsheet if you want to do the calculations. I'll leave it up to you. But give me a nice clean copy of this. And then at the back of the report, you should give me the iShares reports. This is the index here. I use the MSCI EAFE, or the EFA, which is Emerging Market ETF. It's the benchmark, and then here's my German. I used a German small cap fund because Germany's so big. I wanted some volatility and some return in it. So and then this was available. And then I used the MSCI France ETF. used the MSCI Hong Kong ETF, and I used the MSCI Australia ETF, so that's my country exposures. Sorry, and then I used the MSCI Switzerland. I felt that those were the best countries with the best long-term potentials, in Europe and in Asia. And I'll get through some of the calculations. And I'll walk you through this the best that I can, and if I need more time, I'll do it on Wednesday as you're doing the problems. So here, right up front, I just wrote in at the top what my benchmark iShares index is, which is the MSCI EAFE ETF, which is the index. The ticker on that is EFA. And I'll go up to the iShares website and I'll show you how to pull these things down, and then you're going to want to print them out. Okay? And all the data that you need is going to be on these websites. Okay. When you guys come in, can you make sure that you don't slam the door every time? Just kind of make sure it kind of closes. Okay. The portfolio style is emerging markets, moderate to high returns. My target investors are both retail and institutional investors. The portfolio is equity portfolio. The fund type, it could be a mutual fund, but I'm using an ETF fund is what I'm developing. My fee structure is assets under management. I'm not getting any promotes or performance fees on this thing. You can charge, not in an ETF format or a mutual fund format. You can charge assets under management, but you can also charge performance fees above some kind of hurdle rate if you wanted to, if it was a private equity, privately managed fund. My holding period is 5 to 7 years. The fund life, so some of these closed-end funds have finite lives, particularly when you're managing private portfolios or single accounts. They may have a finite life where the investors want to make sure that they're going to get a return of capital, and they want their capital returned at X date in the future. You could always petition for an extension on it, but that's somewhat unethical, and there's a principal agent problem there, because obviously if you get a lot of money under management, you'd hate to sell it all off, especially for your institutional investors, because then you don't get the management fees and stuff. So there's a lot of that goes on. But it is a perpetual life open-end fund. I was a little aggressive on this. I was targeting a $6 billion portfolio over basically 5 to 7 years. I'm going to use 5 years to calculate the fee revenue streams, but I'm going to say 5 to 7 years is where we want to be on a target. Total assets under management. My weighting factor that I used exports. I went up online. I could use the World Integrated Trade Solution website. I could have used the World Bank. I could have used the Organization for Economic Cooperation and Development, OECD. I ended up using the CIA numbers from 2017. So what I did was I put the tickers over here. I got the countries right here. I went up onto the website, and I basically put in the exports. And I wanted to use exports because exports is a reflection of the comparative advantage of the underlying economy. Net exports is going to be distorted by imports. I wanted pure exports. You could have used industrial production or other types of factors to be able to come up with the factor weights. But theoretically, based off of theory, exports is probably the best to use. So I basically just put in the trillions of dollars, in exports for each of the countries, summed them up, divided them back, and basically got the initial weights. Okay, Germany made up at the first pass. Germany made up 46%, France 20%, Hong Kong 16%, Australia 7%, and Switzerland 11%. And then I told myself I didn't want to have all of that much exposure in Germany. So I basically adjusted the exposure down to 30% For Germany, 25, I increased the allocation to France to 25%, Hong Kong from 16 to 20, Australia to 10% from 7, and Switzerland up to 15 from 11. And basically just, came up with the allocations like that, okay? Obviously, there's more scientific approaches to do it, but what I'm doing is I want you to kind of work through the processes so the knowledge is ingrained in your motor skills. Go ahead.
What is the minimum max?
Yeah, what I did then is once I set, my target allocations here, I then set the minimum maximums. So I didn't want to have, actually in this case, I probably want to adjust these to about, let's say 30%. And then, so I don't want to have more than 30% in Germany, and I don't want to have less than 15. Okay. So as I'm managing the portfolio over time, which we're not going to do, the valuations are going to change. And then, let's say all of a sudden Germany has a run on its equity markets, particularly at the small cap size, at the small cap level. I want to set a cap so that I'm not totally overexposing to Germany. I want to set the cap. So whenever you're building a portfolio, you want to do a couple passes to calibrate it, to come up with your strategy, and then you want to set maximum minimums to make sure that over time you're not overexposing to one country or underexposing to it. You always want to maintain some kind of exposure. Okay? Yes.
Is there a number that the minimum max should add up to?
No, I was trying to use like 1,000 basis points above and below it, to kind of set a range. Okay. So like for France, I would have probably said 25%. I'm going to go back and redo this and keep it at 15%. And then Hong Kong, I would have done the same, probably 20 and 10. For Australia, probably 10 and 5, and for Switzerland, I would have done probably 15 and 10, because Switzerland is a major economy, in Europe. It has a significantly established banking system, and it's also known for its healthcare, so it has a significant comparative advantage, and a lot of capital flows through Switzerland from Eastern Europe, and particularly Russia, into and through Eastern Europe, and then out to the U.S. and then obviously Asia and India. So it's a major, capital center, has major comparative advantage. Okay. That page. And the second page is I have, first it's the country and then it's the industry allocations. So what I did was I went and I printed off the German MSCI. Okay. And on the second page of these fact sheets, these are the fact sheets that are available to you on the websites. What I did was I took the top 3 sectors that make up the fund. So I put 23.64 there, 19.04 there, 13.55 there, and then summed them up. Okay. And then divided them into each other to get the weights. Okay. I usually don't want to have more than one sector making up more than 50%, of my country exposure. So I felt pretty comfortable with industrials, since Germany is such a powerhouse in industrial production and exports, to have a fairly high weight in the industrial sector. Real estate was 34%, and technology was 24%. So when I set the minimum maximums, I made it at 25 and 35, 35 and 25, and then 25 and 15. I just kind of came up with it. Okay. Got a fairly tight band, not too wide, but enough to be able to capture, any upside, but also, don't go too far and eliminate any of the exposure from the sector. So that's pretty straightforward. And then what I did is I went ahead and did the exact same thing for France and Hong Kong. Australia, Switzerland. And then what I did was I did one country over here. You'll be able to do the rest yourself after I show you how to do it. I'll show you how to do it in a second. But here what I did is I had Germany, which was the country. The first sector was industrials. So what I did, and I'll show you where to get this data from the website. When you go up to the ETF website, I'll do that in a second. When you go up to the ETF website, it's going to say fact sheet, and then there's going to be an Excel spreadsheet. Okay, and then when you pull up the Excel spreadsheet, it's going to have all the countries, all the companies that are in the country fund. And you can sort by sector within the country fund. The companies in the country fund by sector, you can sort them. And it'll sort, if you do it right, they'll sort it by, not only by sector, but they'll sort it by market cap too. So quickly you can go get the companies. I put the tickers right there. Here's the market values right here. And then I just summed them up, divided them back, and I got basically the weights. What this tells you, these, particularly the sector allocations within the countries, is it tells you the underlying fundamental comparative advantages the countries have. Like Switzerland, industrials is obviously Germans. They do a lot of automotives, they do components, they do machinery. They have a comparative advantage in manufacturing because after World War II, their whole industrial base was basically rebuilt through the Marshall Plan by the United States and the Allies, which gave them a comparative advantage in labor productivity that they've been able to maintain since to this day. So you can really see the composition of the sectors really gives you an idea of the underlying, again, comparative fundamentals for that country and its industrial policies and its natural and human resources. So it's a reflection. And then we have the same thing. You have the real estate, usually top real estate companies, the tickers. Here's their market value, sum it up, divide it back. And what I did over here, Sam, is even though this top firm, LEG, within the real estate sector made up 57% of the market cap of the top three, I constrained it at 50%. So I said, okay, but I'm gonna constrain you because you have too much of the allocation. Okay, so I use the min-max to basically set those constraints. Okay, and then technology, same things. Siemens and those guys didn't come up in these top three, which they would have if I was using large caps, but I was using small caps. Okay, so again, summed them up, divided back, and then got the allocations. And I felt pretty comfortable here because they were pretty much equally weighted within this portion of the portfolio. Okay, and then I'll let you guys look through that stuff. And then back here, country portfolio performance. What I did was I went back, for example, I put in my countries, I put in the country weights, and then for Germany, Germany's the first one. What I did was I went up to the MSCI index here, and it gives me NAV performance right here for 1, 3, 5, 10 years, and since inception. These 10-year and the since inception are going to give you a good idea of the long-term expected return on the portfolios. And the first thing that I do too when I'm looking at these returns for the portfolio, here's the benchmark. So if your return is actually the same as the benchmark, what's your beta? It's exactly the same. It's what? It's 1. Got it. And then you can see this was a little bit bigger, so the beta is higher than 1. In that case, 5-year outperformed. Obviously, it probably outperformed because it outperformed in these two cases. So I basically plugged in for the 10-year because it doesn't give me the 10-year. I just plugged in 13% just to put a number in there. You can use these as kind of a guide. but I was really looking at these two. It's kind of the guide. I could have been more conservative and just put in 11% if I wanted to, but I put in 13 because it is a small cap, a German fund. So that's how I did it. So I went in and basically put in the percentage, then put in the 1 year, the 3 year, the 5 year, and the 10 year. Okay, and then kind of eyeballed it and said, okay, what do I think the expected return is going to be on the portfolio? I picked 13. Okay, I did the same thing for France. Went up to their worksheet. Got their expected return. He underperformed the benchmark. He overperformed in year 3, overperformed in year 5. Basically the benchmark in 10, since inception, almost 6%. Over the 10 years, basically 5.5. So I basically used 6% for France. So just kind of eyeballing it, okay? There's obviously more sophisticated approaches to doing this, but I think this is going to be close enough for us, and it's been close enough for me when I've been recommending these types of products to investors. Okay. So I went through and I basically calculated all the returns, came up with the expected returns, and then calculated a weighted average expected return of 9.6%. I just did that quickly on a worksheet. You can do this in Excel. You basically have the country weights, which are your factors, your factor weights, or your factor tilts, if you want to call them that. That's a very popular term these days. And then I basically have the expected returns, the share of the expected returns, and then sum them up and got the expected return on the portfolio of 9.6%. Okay. And then the expected return looks like on this MSCI EAFE or EP ETF, over the last 10 years, its rate of return has basically been 6.2%. So I'm basically beating that by what? Almost 300 basis points. So I can sell that pretty easily. Okay. And then what you got to do is you're going to have to go in and calculate the weighted average returns for the first year, the third, the 5, and the 10. And then underneath, you got the risk level of portfolio. Again, I was using, on each of these, it's probably not the best benchmark, but it is a benchmark, is on page 2 of these country fund worksheets. They're going to give you the beta against the S&P 500. I would have liked to use if I had the historical return series, I could have run the regression and got the beta that way, okay, or just calculated it. But I thought I'd just use these since I had them, and I was trying to put something together this morning, so you're not kind of floundering around figuring out how to do this. So what I did was I basically put in the betas for each of the countries against the S&P 500, and basically came to the conclusion that it was the risk level in the portfolio was moderately low. It wasn't moderate, where it was a 1, and it wasn't moderately high, greater than 1, or high, significantly greater than 1. It was basically below 1, which I felt it was moderately low risk. Okay. And these countries are pretty big and established too, okay, even though I'm using the small caps for Germany. And then the second is the return expectations, the income return and the appreciation. Okay. So I did kind of a back of the envelope calculation here. You're going to have to do this for each of your countries and then calculate the weighted average income returns and weighted average appreciation. Okay. That's really the key to this exercise, is calculating weighted averages. Okay. I know that might be too simple for you, but it's a really important concept to really ingrain in your analysis. So for Switzerland, he gave me gave me the price earnings ratio. And I know the equation, right, is going to be the price divided by earnings per share. So if I know the price and I know the PE, then I can calculate the earnings per share. Okay? And I can divide that earnings per share by the price to get the income return. Everybody follow? If you know what if it's a three-factor equation and you know two of the knowns, you can solve for the third. Okay? So that's what I did. So I basically went out and rearranged the equation to solve for the price. Right? I can do the EPS up here. So EPS times the price, the multiple times the EPS is going to give you the price. I went to the website, and I'll show you where all this is. I went to the website and got right on the website, it will give you, and it doesn't give it to you on here, which is pretty surprising, that they don't give you the price per share for the ETF. Okay, so I had to go onto the website, and I'll show you that in a second. So I found that the price of the ETF is $35.33. I knew that the earnings per share was $23.65. So if I divide the price of the share divided by the EPS, by the multiple, I can get the earnings per share. So again, the stock price divided by the multiple is going to give me my earnings per share. If I know what the earnings per share is, I can divide the earnings per share by the stock price and get the income return. Yes?
Is the price the current price?
Yeah, it's the current price. And remember that these stock prices don't move very much. They're relatively stable within the short run. Something material is going to happen for the stock price to be really high or really low. And right now we're still in the late stage of the business cycle. There's still volatility, but this is a pretty big economy, so the share price is not going to move very much. And it's a pretty big fund too. The German fund, which will kind of give you an idea of the share price movement, is based off the market cap. And there's about, well, not as big as I thought. The fund was launched, the German fund was launched in 2012 and currently has $38 million in it. That's kind of a small fund, actually. It doesn't have $1 billion in it, but it's a pretty small fund. Again, my point is that you can calculate, you can get the earnings per share calculation if you work through the problem. Once you get the earnings per share, you divide by the current stock price. That's going to give you the income return. Now we know also through the exercise, we know that the expected return for Germany, I calculated it wrong. Oh, sorry about this. I'm doing I can do Germany. I'm going to do Switzerland. Okay, so this is the Switzerland example. So I can calculate the earnings per share divided by the current stock price. I get the return, the income return. I also know that the expected return on the portfolio is 8%. So if I take the total return of 8%, subtract out the income return, I'm going to get the capital appreciation component. So for Switzerland, the income return is 4.2% and the capital appreciation is 3.8%. If you add the two together, they're going to add up to 8%. So I want you to learn too how you can extrapolate the income returns and the capital appreciation, which make up the total return on the fund. Do I need to go through that again? Do you understand? Can you calculate that? Let me go through it again. No? Yes? Yes.
So for the income / appreciation, we do that for each of the countries, right?
Yeah, and then you do a weighted average.
Weighted average.
Yeah,
Okay.
calculate a weighted average.
Can you multiply that by the original weight?
Yeah, exactly. That's the key to this. This exercise is you're using you're not using market cap weights. You're using exports as the factors. Okay, and then you could tilt those factors. Later on, you could do sensitivity analysis or scenario analysis or simulation to get at what you're really trying to get at. Go ahead. Yes.
more so my question was, I thought we were, it doesn't matter. I think
We'll try it again.
I just thought that the total return, I thought, the fund that we were looking at was Germany rather than Switzerland.
Yeah, I
And
was,
I just got it confused.
Yeah, I was mistaken, I
Oh,
apologize.
okay.
So, I was just giving it an example,
Right.
you know, how to do, you can do it you're gonna do it the same way with Germany. I just started on Germany and then I realized, I did the example using Switzerland.
Gotcha.
So when solving for EPS, you pull the price from,
Yeah, they're gonna, I'll show you on the website.
okay,
Okay, when you go up to the website and you click on the fund, the first thing it's gonna give you is some, it's gonna give you a dashboard.
Yeah.
One of the factors, you know, pieces of data that's in on the website is gonna be the price for the ETF share.
okay.
Okay, and I'll show you that in a second, okay? So everybody understand how to extrapolate from the total return, how to calculate the income return, and how to extrapolate the appreciation component, okay? And what's gonna be interesting too is that when you look at your different country funds, there's gonna be a different mix between income return and capital appreciation for each of the countries. If you're doing a small cap fund, the majority of the return is gonna come from capital appreciation. If you're doing a more stable, industrialized, you know, a fund, then a lot of the return or significant portion of the return is gonna come from the income component. Obviously, if the majority of the return comes from the capital appreciation, your total returns are gonna be more volatile. If a significant portion of your returns are coming from income, then the total returns are gonna be less volatile. That's gonna also help you when you're targeting what type of investor you're trying to sell this to. Okay? Any questions on that?
What would you,
Yeah, go
what
ahead.
would you consider more or less volatile? Like you compare the two, or like what a percentage, certain percentage you consider high?
Yeah, I didn't do all of them. You know, if I would have done all of them, I wouldn't have been able to look at all of them. But the smaller the country, the more volatile it's gonna be. So the total return is gonna be volatile, probably come from the capital appreciation, because the smaller the country, the less liquid the market. And less liquid the market, the more thinly traded it is. And the more thinly traded it is, the more volatile the share prices are gonna be. Okay. I mean, that's one assumption, although Switzerland is a major conduit of capital through their banking institutions into, you know, the rest of the world, and particularly Europe. So that volume of capital flows could control for that. So you could have done foreign direct investment as another great factor to use, other than exports. So it's just the foreign direct investment that's coming in to the country is gonna be indicative of the return opportunities and the investment opportunities within the country. And the capital flows that move in are gonna be determined by the underlying comparative advantages of the country and its economic sectors. Okay, so one is outgoing, the other is ingoing. You can pick either one. They're both extremely interesting. They're both valid, in my view, other than GDP or industrial production as weighting factors, because they tell you more about the underlying comparative advantage of the country geopolitically and then its industrial sectors and the mix of its industrial sectors to drive investment opportunities and returns in the future. Okay, anybody else? No? Okay, I'm trying to work through the worksheet right here, and then I'll get onto the page and I'll show you how to do the research. Got it. And then here, you want to calculate the alphas between your benchmark and your portfolio. So pick the benchmark. You already have the expected returns on the portfolio. Calculate the alphas for a 10-year, 5-year, and a 3-year period. Kind of give you an idea of the ability of your fund to consistently generate alpha returns over the investment period. And then you need to come up with a sales pitch. This isn't a very good sales pitch, but it is a sales pitch, where I basically said, if I'm sitting on the other side of a table of an institutional or retail investor or a family office or an investment committee, tell us about your fund. It's a global diversified established market portfolio of moderate risk and moderate high returns. That's kind of boring, but it is a sales pitch. Maybe you can come up with something a little bit more creative than that, so that you can give an elevator pitch if you're asked, what's unique about your fund and what does it do? And why I should buy it. The fund economics is just fees based on assets under management. I'm not doing any promotes or anything like that, but you guys could do promotes if you wanted to. You could lower the fees and increase the performance bonuses that you would get if you can beat the benchmark by X basis points over time. So instead of charging 50 basis points, maybe I charge 25 basis points, but I get 75% of the upside. You know, if I can beat the benchmark by 100, 150 basis points. It's a little creative, something you would do in a custom environment, but it kind of gives you an idea of, you know, how these things are, how some of these portfolios are structured. So 50 basis points times the 6 billion, that's about 1.2 billion per year that we were trying to get under management. It might be a little aggressive. Probably take that down. I think it's pretty aggressive. But kind of gives you an idea of where your numbers could be. And then the 50 basis points times the 1.2 billion per year times the 50 basis points, I come up with 30 million per year in gross fee revenue. And over the 5-year period, we're looking at about 150 million, $50 million. The expenses, I'm going to have to, I might have to pay office space, I might have to pay for all my analysts, and might have to pay for all the data, or at least some share of that stuff. It may be just DTC sits on a Goldman Sachs or a JP Morgan or you know, some kind of banking platform, and we're going to have to pay them basically the expenses, or reimburse the expenses on our expenses. So if 40% of our gross revenue goes to expenses, which comes out to be 18 million, we're basically looking at net fee revenue over the 5-year period of about $60 million. You divide that by 5, it's about $12 million per year. Then I would probably split, you know, that 12 million. If I have to pay Goldman or JP or whoever it is we have to pay, they may pick up the expenses, but we may have to incur the expenses. So these are the net profits that we would make on an annual basis. Maybe we split it 50-50. They get 6 million, we get 6 million. I'll get $1 million, and then I'll give the other 5 million to each of you, the five managing directors and the analysts. So you guys can split that. So you could be looking at $1 million each, you know, here. And if the fund outperforms or you develop new funds, you're looking at more money, you know, from the new funds, and maybe even performances and bonuses based on the assets under management that you accumulate and bring in from your marketing efforts. Okay. So that's basically that. Okay. Any questions? And as you start working through it, you can show me your work, and then I can check it and audit the work. Okay, so I went up to BlackRock. You can use other funds, but other fund sponsors. But BlackRock is the most robust, and it's right here. And actually, if you guys are connected enough, maybe some of you might actually get a job at BlackRock. If your parents have enough assets under management at BlackRock, you're definitely guaranteed a job at BlackRock. I've seen a couple of my students whose families had millions at BlackRock, and they got a job like that. I guess it's like getting into Cal or USC, right? It's pay to play type of thing. So here you can go up to BlackRock. You go under individual investor. You can go up to products. I'm going to go down here to iShares ETFs. And I wanted to view all the funds. And here I can search for different types of funds. So the first thing I put in was global. I want to start with my index. Oh, look, it came up right here. Here's the MSCI minimum volume global ETF, infrastructure, tech. Let's I don't wanna be too specific, I want a broad-based global fund. So I wasn't trying to get minimum volatility. Let's see, what did I end up with? I ended up with the, EFA is what I came up with, what I wanted to use. Here we go. So MSCI, EAFE, ETF. And you can, you click on these. And here's your, some of the dashboards here. And then I go up here to the fact sheet. And you can save down the fact sheet as a PDF or you can print it out. So that's the first thing that I did, was I figured out what my benchmark was going to be. And I knew I wanted to do a German fund, because Germany is such a big presence in the world. So if you type in German, and then here were the three. I didn't want to do a currency hedged, but I did want to do the small caps. I did small cap. So again, here's the fact sheet. I wouldn't print out the perspectives, it's way too long of a document. Everything's going to be in this fact sheet right here, and is going to be in this downloadable Excel. Okay, and I'll show you that in a second. So that's basically how you go, to get the data that you're going to need to fill out the worksheet or to fill out the Excel spreadsheet. Katie did create a worksheet. I did look through it. It's a little confusing. You may want to build your own. And since you all know Excel, it should be pretty easy. Is everybody comfortable with Excel? Okay, great. All right, so let's go to I think the country sector allocations are pretty straightforward. Oops. I think the country sectors are pretty straightforward. The next one is really the companies within the sectors. That's where we need to actually go and get the data. So what you're going to need for Germany, I believe I did Germany. So I went up and clicked download. And I got this spreadsheet right here. So this basically gives you the ticker, the name, the asset class. I don't need any of this stuff. Market value here I need, and then the sector. So to be able to calculate these company sector weights, the company weights within the sector, it's going to give you the market value. It'll give you the name, it'll give you the ticker. Okay, so what I did was I basically took this, right? Took that, went down, went up to data, went over to sort, pick the sector, hit OK, and then bam, it resorted the spreadsheet for me. And I basically got it sorted. Oops, that doesn't look sorted. That is sorted. So as you can see, it's sorted. It's sorted on industry. So then what I did was I just went out, copied this page, over here, created a new worksheet, called it industrials, pasted it in, and then basically, it was all, and then just deleted all of the companies that weren't in the sector. And it was nice enough to not only sort, the first time around, not only did it sort by sector, but it sorted by market cap. And so I can get the top three. Okay, and then I just copied this sorted industry worksheet over into real estate and technology and got rid of everything except for real estate, everything except for the technology, and was able to pull out the top three companies by market value, and then add them up and then create the weights. So that's how you do that. Any questions? Where you get the data and how you work through it and stuff like that? So I'm sure it was a little confusing at first, but hopefully it's a little bit clearer now. Okay, what else? How much time do I have? 15, 20 minutes. What I'll do is I'll go, once you guys pull up and work on your worksheets and stuff, or whatever you're working on, and then I'll give back the deliverables that I have. If you are submitting the deliverables, wait until I hand them back before you give them to me. Did everybody get them? Has everybody handed in their deliverable the first time around, except for Evan? Okay, so yours is coming?
Yeah,
Okay, are you still working on yours?
I have a couple more questions on the previous.
Okay, cool. Okay.